Hey everyone, and thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderVate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on TraderVate's main platform as well. They're a great way to get exposure to the futures market with limited risk. So go to placeyourtrades.com and get the TraderVate app web for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. That is also free. And I will be doing a summary of this episode with my key takeaways that'll be available to download as a PDF. And if you're interested in getting this PDF, please click on the link in my feed, or I'll put it in the nest as well, or visit placeyourtrades.com/spaces to sign up for it. The PDF overview will be available and emailed out to anyone that signs up. And before we begin, just as a reminder, this material is presented solely for informational and entertainment purposes only, and not to be construed as a recommendation, solicitation, or offer to buy or sell, long or short, any securities, commodities, or related financial instruments. As always, please contact a licensed professional for making any investment or trading decisions. And with that, I will introduce our guests. We have Velina. Velina's founder of Faith, with over 2 decades of professional experience and academic background in security and defense. Velina is an expert in the field of geopolitics. As former director of the Austrian Institute for European and Security Policy in Vienna, Velina has a wealth of knowledge and expertise in analyzing the geopolitical landscape and its impact on businesses and organizations. Currently serving as an instructor at the Real World Risk Institute, a member of the Strategic Security Policy Advisory Board of the Science Commission at the Austrian Federal Ministry of Defense, and a peer board member of the Austrian publication Defense Horizon Journal at FACE. Velina utilizes her extensive network of experts and real-world expertise to offer customized solutions for clients to navigate the geopolitical landscape and make informed decisions. Next, we have Bob Elliott, who is the CEO and CIO of Unlimited Funds. Unlimited recently, or actually in 2022, Unlimited launched Unlimited HFND Multi-Strategy Return Tracker. The ETF symbol is HFND. Bob has built innovative investment strategies for over 2 decades. Most recently as a member of the investment committee at Bridgewater and Associates, the world's largest hedge fund. Mr. Elliott worked for Bridgewater from 2005 to 2018, where he created investment strategies across equities, fixed income, credit, exchange rates, and commodities, including many used in the flagship Pure Alpha Fund. His role in the investment committee there, he was responsible for overseeing Pure Alpha's foreign exchange, sovereign credit, and emerging market portfolios. Before that, he built and led Ray Dalio's personal investment research team at Bridgewater for 10 years. He also is the author of hundreds of Bridgewater's widely read daily observations, and directly counseled the Treasury and Federal Reserve at the White House during the global financial crisis in 2008. He holds a BA in history and science from Harvard University. And with that, thank you both for spending an hour with us this morning. I'm very excited to have you guys. First, we will start how we do this in a round. Velina has been with us before. Bob, you haven't. So we do this in a round. And if you have any comments on each other's comments, feel free to join in as well. And with that, I will start with Velina. I wanted to talk about Tehran right now, because they've been talking about a Russia, China, Iran kind of triangle of power. And I think one of the senior officials there said the Sea of Oman and the Persian Gulf, which is the branch of the Indian Ocean, connect a new maritime continental territory with the participation of Asian powers such as China, India, and Russia, as well as the formation of Asian and Eurasian powers in the cooperation structure of the SCO and BRICS. So what are your thoughts on this, and what are the implications for the West?
Hello, Tracy. It's great to be back. And I'm really thankful for this invitation. Of course, for those who have been following my work, my publications, and my participation in Tracy's podcasts, but also other space discussions, they are familiar with my main thesis on the global system bifurcation since actually 2014, 2015. We've been observing this bifurcation on various platforms, including the most relevant socioeconomic networks. And that, of course, includes also the positioning of key geopolitical players. Now, when we consider Iran and specifically this region, the Middle East, which is, by the way, increasingly being named West Asia, of course, we have a lot of fluid geopolitical formations, and here this is, in my view, a perfect case for the bifurcation at systemic level that has a direct impact on the region, namely that the key players are either oscillating between United States on the one hand and the dragon bear, that means Russia and China on the other, when it comes to different geoeconomic projects, including the one that you named. But also, of course, they are hedging. That means that they are trying to avoid a final scenario in which they will be confronted with either or choices. That would mean, of course, that in the Iran's case, Iran will have to, let's say, align with China and to some extent with Russia, even though that, of course, both are also geoeconomic rivals when it comes to, for instance, the sector of oil and gas. And the same goes in the other direction when it comes to Saudi Arabia and other, important players in the region, for instance, Turkey, because once again, of course, on the one hand, they have been trying to hedge against both systemic players. They have been engaging in various U.S., respectively China-led deals and mediation efforts in the region and beyond. But at the same time, of course, all of these actors are specifically cautious when it comes to, let's say, a possible final outcome of this bifurcation that would mean a clear manifestation of Cold War 2.0 scenario between the US and, as I said, the dragon bear, because in a binary world, the options will be quite reduced. Now, when it comes to the transport connectivities, here, of course, Iran saw itself at the crossroads of actually two important transport corridors, the one being the Silk Road initiated by the Chinese. So they had, of course, a very, very important role to play there. But as with the beginning of Russia's war against Ukraine, after almost 20 years of negotiations, another important transport corridor became operative, and that is the International North-South Transport Corridor between Russia and India, with a very important positioning of Iran. And of course, one interesting element prior to the 7th of October, when the most recent military conflict between Hamas and Israel broke out, we found out, so we witnessed a very interesting development, geoeconomic development, and that is the announcement of IMEC corridor. That would be a geoeconomic corridor, including connectivity, transport, railroad, and all of this interesting, energy, of course, components between India, the Gulf region, specifically including the UAE, Saudi Arabia, and Israel, and Europe. So in this context, in this geopolitical context, of course, the two big losers from this newly announced connectivity would have been Iran and Russia. So in a sense, right now we are in this very competitive context of different connectivity corridors. And as I said, at the regional level, we have plenty of ad hoc fleet formations where all of the relevant actors are trying to capitalize on the systemic competition between the United States and China, with one key exception, and that is Russia, because in my view, Russia already has positioned itself on the side of China, and practically is now trying to capitalize on this modus vivendi of coordination by practically pursuing three main goals. First being the subjugation of Ukraine, second being the destruction of the European security architecture, and the third being practically the pole position in this systemic competition between the United States and China. I will stop here.
And then, since we are talking about these countries, what are your thoughts on the power of BRICS? Could a BRICS currency realistically exist? And do you see that ever becoming a problem? If so, for the USD as a reserve currency?
I've been following the launch of BRICS and all of these other formats that some of which you've mentioned, such as the Shanghai Cooperation Organization, and obviously also the most relevant one being G20 right now, including the most developed 20 economies, and since this year also including two institutional players, the European Union and the African Union. And I must say that contrary to previous development stages of BRICS, which are more or less, let's say, at the level of posturing. Of course, China needed a big, let's say, platform to engage with some of the relevant players. And if you take a look at BRICS, you couldn't find more contradictional players alone, of course, because of the regional confrontation between India and China. But in a sense, what is different now, in my view, is actually this systemic geopolitical context. And we should be paying attention as to how exactly these specific BRICS players, and of course, given that we may see new members starting with next year, so we don't know exactly whether those who have been invited, including three key players from the Middle East, UAE, Iran, and Saudi Arabia, which are commodity powerhouses at regional level, and of course, key players from Chinese perspective. So here, of course, the open question mark is whether we will not see a trend towards the establishment of BRICS as a kind of commodities platform. And of course, the two important issues, the two important trend projections I am carefully following are as follows. First, we know for a fact that Russia has been initiating the payments for natural gas in euro. And of course, we had more than 150 to 160, actually, on average, BCM supply, which have been, as I said, initiated in euro. Now, as Russia is already more or less diversifying away from Europe because of the war, and is turning towards Asia, we've seen already this first trend, that is that Russia actually pressures its clients to conduct payments in alternative currencies, of course, away from the euro, and specifically, more towards the Chinese yuan and other currencies, for instance, the UAE currency or Indian rupee and so on. The second, of course, important trend that I want to follow in the next 2-3 years, I think that 2025, 2026, so after the election, will be the key period to follow, is whether specifically BRICS and 20 countries, so those who are really eager to further develop and have the potential to economically develop, are going to initiate alternative payment systems, be it in national currencies or in any kind of other collective currency payment, which will be practically the interesting moment when it comes to, of course, the role of the dollar. So the way I see it is that right now, this format is at an inflection point, and it is and they're practically testing the ground for several different important developments, but we are not there yet. And obviously, we don't know for a fact whether these intentions will be successful in the end.
Excellent. And we will come back to Velina. I want to move over to Bob here for a minute. I wanted to talk about China for a little bit since we're kind of on that subject. And it seems the whole world is watching China for signs of growth and global economic health. So what are your thoughts on the property sector explosion? And do you think this was a controlled demolition to purposely pop the bubble, or is it indicative of something much deeper?
Hey, well, thanks for having me on. This is fun to get invited to this. I think on the China side, first of all, just the highest level story in China is that they're facing what is like a very classic macro dilemma, which is that the economy is too weak, and should necessitate easing. And we can go into the particulars about what easing is the right easing and most effective and stuff like that. But the economy's growing too slow, given the baseline productivity growth and employment situation there. And at the same time, they're very worried about depreciating their currency, or allowing a depreciation in the currency as well. Even though, the basic underlying fundamentals of the exchange rate dynamic there are, considerably weaker than they have been in some time. And so typically when you see an economy that has a need for domestic stimulation and a need for a weaker currency, you should get interest rates to fall and you should get the currency to fall in order to re-stimulate that economy. And I think China is operating in a way that's basically constraining themselves from being responsive. And when I say constraining themselves, they're making a decision to constrain themselves. They could very well ease monetary conditions or fiscal conditions meaningfully. They have more than enough capacity to do that. Their debt is in their own currency. They could print the money to fund it, to ensure that there isn't an interest rate rise. They have every ability to ease, to support the economy more broadly, and then to respond to the downward dynamics in the property sector. And they also have a ton of resources to be able to manage currency weakness and even totally arrest currency weakness, at least for some time, because they've got $3 trillion of reserves. And so if they wanted to ease interest rates and do fiscal stimulation and keep currency downward pressure mostly at bay, at least for a period of time before there's weakening elsewhere, they have more than enough firepower to do it. So I frame it all that way because I think it's an important, that macroeconomic context is important to then look at and say, what we're seeing in terms of what's going on there is not, it's not an outcome of a set of private sector dynamics that are just happening. It is a set of policy decisions that are being made by the central bank and the central government to, and must be at some level, she in particular, to pursue this path of weak economic conditions and current, and essentially high prioritization of exchange rate stability. And so, I think when you think about the private sector, when you think about the housing sector, obviously there was a lot of housing that was a big part of the sort of, let's call it fiscal stimulus in sort of a broadly described way, that occurred coming out of the financial crisis and helped support the economy for a while. They're sort of recognizing, I think everyone recognizes that led to a lot of excess spending and unproductive investment and stuff like that. And so it's natural and frankly prudent that they start to pull the plug on all that and try and shift spending and investment towards more productive areas of the market. It's just that they're not doing, so that sort of rebalancing, let's say, it's a bit of a loaded term, but that rebalancing is the sort of thing that makes sense for them to do. And so that part of their policy is a sensible policy. The thing that is, I would say it's not sensible. It's just they are making a choice not to sufficiently offset that with either, direct transfer fiscal stimulus or fiscal stimulation that is supportive to investment in other productive areas of the economy. I mean, the GDP per capita is still very low. There's lots of things that can be invested in that would be highly productive. So that policy choice, that's interesting. That's an interesting set of circumstances, it's not, from a Western perspective, they're certainly not solely prioritizing medium-term growth in terms of how they're behaving, how she and the central bank are behaving. And that sort of reaction function, I think, is really important in terms of just thinking about it. If those are their priorities, then basically, if, exchange rate stability is their primary priority and they're okay with having kind of crummy growth, well, if that's their primary decision-making framework, that will not change until the pressure comes off the currency. And the way the pressure is going to come off the currency is by having weakening in the rest of the world. And the rest of the world has been, meaningfully more durable in terms of growth conditions than probably they expected. And so the idea that China will be kind of crummy until the rest of the world weakens, until the PBOC has the room to ease monetary policy, and stimulate the economy without undue pressure on the currency, that's kind of the stasis that we're in.
So it's kind of a hard spot right now for them.
Yeah.
I work, as far as, what to do, because I know everybody's been expecting all of this stimulus and really nothing they've done really is that stimulatory. I mean,
but they're not doing any. I mean, those of us who lived through look at 2008, they wanted to, or 2009, they wanted to stimulate, and they had no problem stimulating, right? they're not. It's not like Japan, where it requires the private sector to behave in a certain way in response to the stimulative monetary and fiscal policy. Like, if China wanted growth at 7%, they could do it. Right? They have all the resources in the world to do it. They have all the ability to direct it. They are making a choice to have crummy growth. It's a policy choice to have crummy growth, in particular because I think they're concerned about the exchange rate stability.
that makes sense. Then I want to move over to the U.S. For a minute. First, obviously, let's talk about the most recent thing with that CPI print that set markets soaring. Everything soaring. What are your thoughts on that, and especially that healthcare print?
Well, I think if you look at the financial markets are basically pricing in a perfect soft landing, and the soft landing just gets more and more perfect every day, it seems, where, inflation will moderate perfectly to 2% and be there forever. And, we'll have earnings growth, double-digit earnings growth for the next few years. And we'll have, no commodity price inflation. If anything, commodity prices, are oil in particular, are priced to fall. And where the Fed will perfectly tweak monetary policy down 100 basis points in response to the disinflationary pressures, but not not have to ease so much because there's a negative growth shock. And so, you look at that and it's just is a soft landing possible? And by soft landing, and some people say all sorts of different things about soft landing, can inflation durably go back to the Fed's target? Durably is an important word. Can it go durably back to the Fed's target without a meaningful weakening of economic conditions? That's what a soft landing is. And I look at the set of conditions here. The markets are saying essentially like, sure, the market's cross asset market pricing is certain there will be a soft landing. And what I'd say is maybe I'm underconfident, but certainty on a soft landing would not be my opening bid for the probability that we get there. And I think that's because there's a number of different paths that are mispriced in the financial market, around relative to that perfect certainty, which is, we may well have inflation be higher than what people expect. Like if you have strong growth that continues and tight labor markets, inflation is probably going to be higher than people expect, in 2024 and beyond. So, things like oil look from a macro perspective. I'm not a micro guy on oil or an expert by any stretch, but commodities and oil in particular look cheap relative to what's priced into growth. Equities, at the same time, so inflationary pressures could emerge at the same time. And then also in that context, if growth continues to be strong, there's no way that the Fed is going to cut 100 basis points in 2024. No way. Like, just not how it's going to work, right? If growth continues to hold up, they're not going to do a Greenspan tweak of monetary policy to bring it down. So it seems like, those are two places that are mispriced. And then on the flip side, it's also very possible that this doesn't work out in the sense of, that the momentum, we've seen some weakening momentum in the economy, and that could just continue much and accelerate much faster than people are expecting. So you don't get the double-digit earnings growth. And so I think it's a hard time because, essentially soft landing is priced in a certain way that the right portfolio of positions is taking on is basically saying, well, the equity market is pricing for things to be too strong, so I want to fade that. But the short rate market is pricing for things to be too weak, so I want to fade that. And the inflationary pressures that are priced in the oil market, inflation and growth that's priced in the oil market looks too weak, so I want to fade that. And so the combination of different positions are actually they're all kind of mispriced in the 60-40 way, although they're mispriced in opposite directions. So, the sort of portfolio that looks interesting today is like short stocks, short rate, and maybe the twos, long oil. That's a difficult combination to conceptualize, but I think that's the reality of where we stand with the markets today.
So does that put you in the hard landing camp or the no landing camp?
Well, I think two different things. There's one, which is what do I think is the highest probabilistic path of the macro economy? And I think that, it is extraordinarily rare to have a circumstance where inflation pressures that have been elevated for years are resolved without having a meaningful macroeconomic slowdown. And even like a year ago, a lot of people thought there was going to be an immediate recession. And I was like, no, the recession, it will come. The landing will be hard, but it will take a lot longer than people expect. And then the other point, which I think is important, is it will probably also be harder than people expect, but we're not there yet. So let's not get to that point. We don't have to necessarily go into all that right now. But this idea of a hard landing will come, it will be later than people expect, and it will be harder than people expect. That's still my central expectation. When you're looking at financial asset markets, what you have to think about is they're pricing a set of probabilities for a certain set of paths. And so the probabilities that are priced in, for instance, in the equity market, being underweight or short equities, is very consistent with that view that probably will go down that path relative to equities, which are pricing in perfection. But I also think there's a possibility that it takes the Fed a lot more work to get us there than is currently priced in on the other side, which I guess is sort of like the no landing scenario if you had to pick, which is the short rate market's underpricing the no landing scenario and the stock market's underpricing the probability of the hard landing scenario, which is not meant to be wishy-washy. It's just meant to say, look, different markets price in different things. And when you're trading them, you're just trading them what's priced in relative to the probabilities of what will likely transpire.
Excellent. And we will come back to that because I still have a lot more questions on the U.S. economy in general. But let's move over to Velina. And I wanted to talk about India for a little bit. I know you've been there several times. And as investors, India is looking particularly exciting, and particularly for the commodity sector. So what are you seeing there as far as economic growth, and what may or may not be some of the hurdles?
Well, thank you for this question, Tracy. So on the upside, I've actually published a piece, a geopolitical article. I think it was in April 2020. It was just at the beginning of the pandemics, and I actually claimed that India will be probably one of the biggest winners of the post-pandemic scenario. Of course, mostly based on the premise that we will witness a global reconfiguration of global supply chains, which is now meanwhile a fact. I think that we all are on the same page that this reconfiguration of the global supply chains is here to stay. And it has a lot to do not only with the post-pandemic context, but also with the systemic competition between United States and China in general. And here, when we think of the upside and why India will witness a rather optimistic macro scenario from a geopolitical, but also from a geoeconomic perspective, is that first and foremost, it has almost zero prospect for recession in the next years. In fact, it's already projected to become world's economic, actually world's third economic power, probably in this decade, given the acceleration of changes and developments. So we will have a lot of fields of activity, from space, defense, cyber technologies, to the rather classic sectors, transport, energy, infrastructure, mostly, of course, those that are very much under control of our union governments or the state government, which will, of course, invest a lot. We have already the situation with very positive demographic changes, contrary to the demographic picture of China. So India already also has overtaken China in demographic terms. And even though, let's take a look a little bit at the downside. Even though that, of course, India and China are, and next to it also Pakistan are in quite conflictual relationships. We've seen military escalation and direct military clashes on the regular base between Indian and Chinese troops. The situation of the relationship, the bilateral relationship between India and Pakistan is not good as well, and these two countries are nuclear powers. I argued that this kind of competition, this kind of rivalry between the two Asian giants will be kept under the threshold of, let's say, direct nuclear exchange or direct full-scale military confrontation. Why? Because the Indian government will be eager to preserve the stability of the region for the sake of economic growth and prosperity. And in that matter, one of the explanations why India is also part of China and Russian-led formats, such as the Shanghai Cooperation Organization, BRICS, and so on, is exactly that, because India wants to be part of the conversations. It wants to steer some of these conversations, to influence them, but also it is a way of indirect influencing of a lot of these discussions, because we don't have to talk only about economics and trade relationship. As I said, we talk also about security and defense. So all in all, when it comes to the downside, mostly I see the regulatory basis. We deal with the country, and I know for a fact that you, Tracy, are not a big fan of the European Union. So if we take the example of the European Union as probably the biggest institutional regulatory power. The European Union is famous for regulation, so India is probably the POMDO, so the alternative of this regulatory body. So this is, of course, in the short term, term scenario, still a big obstacle for investors, for people who actually consider getting involved in the political, economic, trade related development of the country. And I want to see, of course, what is going to happen after the election next year. So before the election, nothing is going to happen, but after the election, probably, which is next year, we will see some efforts towards more liberalization, because India obviously needs to open up in terms of development. So development, the 3Ds is going to be the big issue for India when it comes to the domestic issues. Of course, we also have a lot of developments that are to some extent quite relevant for federal states, given that each province is being led by its own government. But also we have, of course, some long-term structural issues that India will be facing with, of course, the speed of economic growth and with the rise of middle class and so on. So all in all, if we take the upside and the downside of India's development into consideration, I would actually argue that India still remains one of the most bullish cases for investment. When we consider, of course, the geopolitical and the geoeconomic factors.
Excellent, thank you. And then since you brought up Europe, so what are your thoughts? I know we've talked about this in the past, but recently, what are your thoughts on the EU and green transition? We've kind of seen, since we last talked, we've seen some big failures over particularly last month with wind, with Siemens and Ørsted, financial debacles. So where does this kind of put the EU in terms of green transition? Is there hope for Germany ever to return back to nuclear? And what are your thoughts on what seems to be the quickening pace of deindustrialization of the once manufacturing powerhouse Germany? I know that was kind of a lot, but.
Well, that's quite a lot. And we, of course, want also to listen to Bob's statement. So let me wrap it up in a very short and obviously also quite unpopular way, because I've been quite vocal in terms of criticizing the current directions of many of European policies. So specifically, if I take a look at the geopolitical and geoeconomic portfolio of Europe as a collective actor, I would rather say that it's not the West that's in decline. It's actually the European part of the West as a collective factor that is due to both geoeconomics and geopolitics. On the side of geoeconomics, we have current situation of not just stagnating economies, but really some of bad economic choices and decisions. You named some of them, the way how they wanted to, bureaucrats and governments wanted to speed up the process of energy transition, even though that Europe has been witnessing the worst energy crisis prior to the beginning of the war already in 2021. And now we are witnessing the consequences of these bad political choices, including the example that you gave with Germany's deliberate decision to actually withdraw from the nuclear policy. In my view, and this is my recommendation, Europe's energy transition won't be possible without actually including the nuclear energy as part of the energy mix. So I think that Germany just picked the wrong horse in this race with France, and we already see a clear trend where, for instance, Poland, we have new European states, including the nuclear energy as part of the energy mix. This is the case of Poland, but we see also countries that have relaunched the nuclear energy as part of the mix. This is, for instance, the case of Sweden. Also, when it comes to the geopolitical challenges, I mean, it was absolutely clear right from the beginning of the war on the 24th of February 2022 what was needed to be done on behalf of Europe. In fact, if it had not been for the American American military support for Ukraine, we know for a fact that Ukraine will have capitulated in the first months of the war because Europe was too slow and too undecisive in the first, critical months. And even now, 20 months later, when Europe has overtaken America as a collective actor in terms of the macro aid for Ukraine, that means not just military, but also financial, we clearly see once again undecisiveness. We see countries which, because of change of political government, are now actually going against the delivery of military aid. This is the example of Slovakia. We see countries like Hungary, which will be blocking probably the process in the future. So all in all, we see that in terms of geopolitical challenges, I mean, the only clear path from Europe's point of view for making this war as short as possible was to be very decisive at the beginning, at the first stage, and to actually deliver at the first stage and to produce as necessary as possible. Whereas now, given of course, the stalemate scenario in the war, and this is by far the worst conventional warfare since the end of the Second World War. Just for clarification, for those who are not familiar with what's going on in Europe, we see actually how Russia has once again managed to diversify, to not just adapt, to diversify with the help of third countries such as North Korea or Iran, whereas European governments are still kind of too slow in terms of production of ammunition and in terms of delivery. So on both sides, on the side of geopolitics and on the side of geoeconomic, I just see that, and also I suppose that Bob can actually add more to the macro economic perspective, where Europe is already in a scenario of recession. Some of the countries, such as Germany, have entered recession already in May, June. And the very fact in this final sentence that the European Union has now invited Mario Draghi, the famous whatever it takes guy, to take care of the precarious situation of European economy and to provide a plan how to actually improve the general state, actually is telling for the situation.
Excellent. Thank you. And then we'll move over to Bob. Back to the U.S. This is kind of a two-part question. One, your thoughts on the labor market, the U.S. labor market, and why it's remained so resilient and what this means for the Fed. And then kind of along the same vein, your thoughts on the health of the U.S. consumer, as we've seen default rates picking up. Everybody's talking about it, but we're still at historical lows.
Yeah, on the I guess on the U.S. economy, the labor market is tight, secularly tight. For those of you who read my tweet on every Thursday about this point, and I think that we had an incredibly hot labor market in 2021 and early 2022 that has since cooled very modestly. You might call it normalized relative to the post-COVID boom. But the challenge with the labor market, challenge or not, but the reality with the labor market is that given the secular demographic experience, it just doesn't take that many jobs to keep the labor market, reasonably tight. We have labor force growth. Of course, there's a lot of ambiguity about this point, but let's call it a million, to 1.5 million jobs, let's say, in terms of labor force growth. Okay, well, what does that mean? That means payroll employment goes up by 100,000 a month, and labor markets, or more than 100,000 a month, and then labor markets are, still pretty tight. And so you look at that and you sort of say to yourself, well, I mean, 100,000 jobs a month is just not that many jobs. And so when people look at these payroll reports, I think a lot of people are focused on the fact that they've moderated from, 500,000 jobs to 150,000 jobs, but still that's a fine situation to be in. And so what that means is, with labor markets continuing to be relatively tight, even with moderate growth in employment, that there will continue to be, labor shortages in to some extent, structural labor challenges, labor hoarding, and more higher wage growth than would otherwise be the case. And that's essentially what we're seeing, is that even though there's been like a bit of a softening of the labor market, if you look at and wage growth has come down from in the let's say in the 5 to 7 range, we've now fallen into the 4 to 5 range, depending on your measure of choice. But that's still a couple percent above where it was pre-COVID. And that's important, right? Because pre-COVID, we were at essentially the Fed's target when it came to inflation. If we have, let's say you just assume that we have the same labor productivity dynamics today as you did 5 years ago, and you have nominal wages that are growing at, 2% higher at a 2% faster pace because of embedded inflation experience causing a bid for wages, plus the tightness, combined with the tightness of the labor market. Well, the Fed can't get back to its mandate under that circumstance because inflation is just too high relative to the, to the productivity growth component. And I would argue, although the data is a little bit goofy in this way, that probably actually productivity growth today is lower than it was pre-COVID for a variety of different reasons, in terms of how much you're getting out of an hour worked in an economy where we went from essentially 90% of the white collar workers being on site to white collar workers being 90% on site to being something like 35 or 40% on site. It has to have a negative productivity, or almost certainly is having a negative productivity effect. But who knows? You don't even have to go there to assume that you don't even have to assume that there's much lower productivity growth today than there was pre-COVID to assume that, or to basically solve for the fact that the tightness of the labor market, the wage growth that we're seeing at 4 to 5% is too high for the Fed to structurally meet its mandate. And so I think what we're seeing, and this kind of ties to your earlier question about inflation, is measured inflation has come down. That is true. But structural dynamics which drive inflationary pressures, which are driven by the nominal income growth relative to the productivity growth of the labor force, that structural dynamic has improved, but is not close to what's necessary to create a persistent, durable 2% inflation. And I think that's when Chairman Powell says he's still worried about inflation, that's what he's worried about. He's not worried about, will CPI number get printed in a certain way. It's not how he's thinking about it. You just hear it. He's not thinking about that point. He's thinking about the structural dynamics that are going on, and those are yet resolved. And so, I think the issue is, how do we get there? Well, I think there's a long path to get there in this whole cycle. It looked like we were going down that path with, some expediency, with interest rates rising, stocks falling, and starting to see some weakening of consumer demand. But we essentially had a big easing that has occurred, a market-based easing to some extent, and then a Janet Yellen-based easing over the course of the last 2 weeks, and that is likely to extend the cycle further. So in a lot of ways, we're back to the point where, when it comes to the ordering, first you have to have interest rates rise and tight monetary policy for longer. Then that'll start to weaken the stock market. Then that'll start to weaken demand, and then that'll start to weaken, earnings, and then employment, and then wages, and then inflation. We're still, if we just look at that pattern of events, we actually took a step back. We're back to the point where we have to have essentially higher for longer in order to get us to the point where we see start to kick off the meaningful slowing of the economy. And until that happens, inflation and the tightness of the labor markets will be such that it's, the labor markets are still too tight and wage growth is still too strong relative to productivity growth to achieve the Fed's mandate.
And then on your thoughts, are you worried at all about the health of the consumer as we're starting to see some deteriorating data, but, we're still coming off of historical lows?
Yeah, I mean, I think that credit, there's obviously been some credit deterioration and credit card charge-offs and auto delinquencies and all that stuff, which, mostly to my eye looks like we went from a point where, like 24 months ago, I mean, how could you default on it? It's like, you're flush with cash, student loan payments were pushed off. Like, essentially it was like impossible to default on something. And now we're sort of normalizing back to a world where, like, it is true, the sort of tail edge of the economy is starting to run into a pinch, and is starting to default in various different ways. But look, if you study the history of really credit events and credit dynamics through time, like, you basically have to have one of two things happen in order for there to be a real sharp acceleration of credit defaults, either across anything, cards, autos, houses, whatever. People either have to lose their jobs, which isn't happening right now, right? Or there has to be a meaningful reset in interest rates, like is what happened with the subprime and floaters that happened in the before the GFC, and that's also not happening because basically everyone's locked in low rates forever, and so households have locked in low rates forever, and so what is actually going to be the spark to create acceleration of credit defaults in this economy? I don't think it's, I think a lot of folks remember that credit defaults kicked off the deterioration that happened in 2006 and 7, but that set of dynamics was super unusual. Almost always credit defaults, particularly from the household sector, are the last thing to happen rather than the first thing to happen. And we're back to, a more old time business cycle here. So probably what we're, there's going to be a lot of other stuff that's going to happen, and then we'll start talking about credit default.
Got it. And then one last question. You've talked a lot about late cycle bond rallies before. Can you dive into this a bit? And given, do you see this latest rally as sustainable? We just had the latest B of A managers survey that came out that showed investors were dumping cash and hold the biggest overweight position in bonds since 2009. So what are your thoughts on the bond market right now?
Well, I think the biggest picture thought, and I when bonds hit in the ballpark of 5%, and there were some people drawing lines to 13%, I said, hold on a minute. You gotta understand the bond market at 4.5% or 5%. The composition is very different than the composition when it was at 2%, right? And what that means is that there's a lot of yield sensitive buyers that emerge in that as you start to elevate the interest rates. And that's literally what we've seen is, even though the deficit's up, yield sensitive buyers have picked up. And that Bank of America survey is a good example, right, of yield sensitive buyers shifting their positions in response to the price changes that have occurred. And so that's kept a lid on things. I think basically what we've seen is that there's been, not only did we sort of get to that point, but then on top of it, essentially Janet Yellen decided to do an easing step, which is, politically advantageous, probably macroeconomically stupid, but politically advantageous. And the reality is that she could keep doing it. I mean, in fact, Janet Yellen in the next QRA could cut bond issue, cut coupon issuance, slow coupon issuance meaningfully, and still coupon, bills would be under 30% of the overall debt profile of the U.S. and 30% isn't even all that high if you go back through all history and stuff like that. it's been well above 30%. And so, in history. And so, look, like, could Janet Yellen keep a lid on this bond market by continuing to ease, to limit coupon supply and duration supply and keep the low end, long end of the bond market contained? Like, absolutely she could. I mean, certainly for any time frame that we care about as traders. The consequence is just that if she does that, the Fed's going to have to do more because, by keeping in a late cycle, a later cycle environment, an expansionary environment, if your response to an expansionary environment is to lower interest rates on the long end and stimulate equity strength, the outcomes of that are going to be such that you're not going to achieve your mandate for inflation, right? Growth will be too strong relative to your mandate for inflation. So that's probably, I think that's certainly a plausible dynamic that we can see, which is why those December 24 SOFRs are crazy in that context, which is if you're going to have, you're not going to have a circumstance where there's a strong economy. I mean, I would argue, unless the economy is terribly weak, the Fed is not going to cut in the way that's being priced in. And certainly if it's stronger than people expect, even if it's moderately good, supported by all these easing steps that have occurred, like there's no way the Fed's turning around and cutting. I mean, in March, Fed's going to cut in March? No way. Not going to happen.
Are you done talking or did you cut out?
No, I'm done talking.
Oh, good. Yeah,
It was so compelling. Silence the whole
thing. No, it was. I mean, I was going to ask you that if you saw, if you look at the CME Fed Watch tool, it's pricing in kind of a cut already in June. But from what you just said, I suspect you don't think that's going to happen.
Well, I'll tell you what's not going to happen is we're not going to have stocks anywhere close to these levels and have a cut, currently priced. I mean, some reasonable probability of a cut priced into May, right? I mean, even a reasonable probability, 25% probability priced into March. Like, if you're a stock investor, you sure shouldn't be buying stocks on the expectation that there's, if you think that the Fed's going to start cutting the way that's currently priced in the first quarter of 2024, because the set of conditions that will lead them to do those cuts would be terrible for the equity market investor. And yet, I think that's kind of the big gap that exists in the market today.
All right, thank you. And we're coming up on the hour, so then we'll do our final round, which is the same question for both of you. And that is either talk about something that you wanted to talk about that we didn't get a chance to cover today, and or what are you particularly looking at, say, over the next 12 to 24 months that we should really be keeping an eye on. And we'll start with Velina.
Thank you, Tracy. So here are some interesting geopolitical trend projections I will be looking at in the next 12 to 24 months. So first, Russia's war against Ukraine is not going to end in the next year. 2024, we have presidential election in Russia on the 17th of March. Most likely Putin will be the president again, but the interesting trend projection I will be looking at is actually how the Kremlin system is going to start preparing for the predecessor, so the successor of Putin's system. We saw already some cracks in this year, and I think that this trend is going to continue. At the same time, we are in a stalemate scenario right now when it comes to Ukraine, but obviously after the culmination of this phase, we will see new, let's say, military actions on the front lines starting with next year. So fortunately, 2025, 2026, probably this war will be somehow settled. Unfortunately, as of now, it looks more like a scenario of frozen conflict. That means some territories still remaining under Russian control, while others probably will be increasingly going into the Euro-Atlantic bloc of European Union, NATO kind of integration. And here, next interesting trend I'm following is the manifestation of a new invisible iron curtain, similar to what happened in the first Gulf War. And this one will be happening along the eastern flank of NATO, which is now growing with some Nordic states. So most of the activities will be happening in this particular area from the Nordic, Arctic, Baltic Sea, and then along the Eastern European, South Caucasian terrain, and then moving towards Black Sea area and Turkey. And of course, now this will mean more military activities on both sides, but also it will be a kind of an internal power reshuffle when it comes to the role of the traditional Western European players, such as Germany and France. Next interesting trend I'm following is obviously linked to the conflict between Israel and Hamas. Here, once again, I do not anticipate the end of the military conflict before spring next year. So we will have a very, very long ongoing military conflict with precarious humanitarian situation. And at some point of time in the future, because I argue that no single regional player, including the three key players, United States, China, and Russia, wanted a war in the region right now. So the only actually player on the ground that wanted a war was Hamas, and still remains Hamas. So I don't see a risk scenario for spillover effects, but we never know, of course. Right now, it is quite of an unstable situation. The next important trend I follow is obviously linked to the systemic scenario, that is the bifurcation between United States and China. So the disentanglement between these two systemic rivals. And here I argue that we will see probably in the scenario after the election in the United States. So probably at the end of 2024, starting with 2025, we will see the first manifestation of this bifurcation also affecting the global financial and capital system. So monetary affairs and financial, obviously the financial system, the way we actually know it, is probably going to undergo the most systemic changes. And here we should pay attention, of course, to the regional formats that are now emerging. G20 is going to increasingly play a role. India, as I said already, and the formation between China and Russia, when it comes to actually providing a kind of a anti-US, anti-Western narrative, and the role of the global South, the way how both blocs will be competing over the hearts and minds, but also for the access to natural resources, raw materials, rare earths, linked to digitalization and energy transition. This all is going to happen simultaneously. So it's going to be a very volatile and insecure environment. But no nuclear exchange, no military attack by China on Taiwan, and obviously no military confrontation between United States, China, and Russia, because I want to end with a positive note. So in a sense, yes, it is quite dire and volatile, but still could be much worse.
Thank you. And then the final round to you, Bob. Talk about something that we didn't get to talk about that you wanted to talk about, and then what should we as investors really be looking at over the next 12 to 24 months?
I think the biggest thing that's going to happen over the next let's say the next year, is that the evolution of the macroeconomy will be a lot more boring than will be the evolution of people's expectations around the macroeconomy. And that'll be really important, because that'll create a lot of opportunities. Like, the macroeconomy is slowing. It will probably meander slower further. But as it has been for the last 18 months, give or take. But there will be a real obsession with calling the next turn, the same thing that we've seen over the last year, is this very fast-moving shift in expectations relative to the slow-moving reality, and that's the thing that's going to create a lot of opportunities. I mean, heck, we've had, I think, 4 rounds of pricing out interest rate cuts, in 12-month forward interest rate cuts over the course of the last year. My guess is we will continue to see the same thing, and a lot of this policy action, particularly the policy action by the Treasury to limit duration supply, has slowed that process down further than probably what we would have thought just a few weeks ago. And so expect very whippy sentiment and very slow reality. So you stay disciplined out there. That'll be the you'll find a lot of opportunities in fading stream expectations relative to very modestly moving fundamentals.
Excellent. Thank you. And thank you both very much for your time today. I really appreciate it. I know that our guests really appreciate it. And I hope to have you both on again. With that, follow Place Your Trades, follow both of these people. They both, Velina and Bob, both post excellent information all the time. If you want to keep up with macro markets and geopolitics. And with that, I want to thank everybody for attending. Thank you to our speakers, and we will see you next Wednesday.